But essentially, it has so many dope benefits. So for one, you don't have to put a down payment. You don't have to worry about closing fees. And you don't actually pay any insurance. So you know how we just spoke about PMI and MIP? You don't have to worry about any of that stuff, which is super nice.
What's up, everybody? Welcome to episode 15 of Rookie Mondays. Today we'll be discussing some very creative ways to get into real estate. We're talking about some methods that allow you to put 0% down on a house, which is amazing. So I'm excited for this one. Let's get right into it.
All right, so the first one we want to cover with you guys is conventional loans. So this is when you can put as little as 3% down to all the way up to 20% down on a home. You don't actually have to put 20% down if you're buying a residential home though. The 3% comes in if you have a good credit score, if you have good income, et cetera, et cetera. So just speak to your lender and they basically tell if you qualify for the 3% or 5% or 10%. But please note, if you do not put 20% down, you do have to pay something called a PMI, which is insurance. So you want to explain that really quick?
Yeah, PMI is private mortgage insurance. It's what the lenders use to secure their loan. They got to make sure that they actually get money in case you default on their loan.
Exactly. And if you do put 20% down, on a residential, you don't pay the PMI. But if you're buying an investment property, you actually have to put 20% or even 25% down because obviously it's not a home that you're living in, right? You're going to be renting it out, et cetera, et cetera. So that's the first one, conventional loans. The next one is more exciting, so let's dive into that one, FHA. So let's get into that.
Yeah, this is one of the most popular loan packages, right? It's called the FHA loan. It's given by the Federal Housing Administration. And the beauty of it is it allows you to put down only 3.5% down on a house.
Which is pretty dope.
That's amazing, right? And the thing is, it depends on your credit score. So all you have to do is have at least a 580 and you could put only 3.5% down. Mm-hmm. So a person with an 800 and a person with a 580 is both putting 3.5% down,
right? Down
payment on a house. Now the thing is, if you have between a 500 to a 579, you have to put 10% down. Mm-hmm. Okay. Now, qualifications for a FHA loan. You have to make sure that your credit score, like we said, is at least a 580 for 3.5%. Your debt to income ratio should be at least 43%, or at most 43%, excuse me. And then, it could go up to 50% as well. And then your property has to be approved by FHA, right? Because the thing is, they're going to send people to check it out and make sure that it's qualified. They want to make sure that it's a house they're willing to put a loan on.
Right. They're not going to let you just take a random home that's completely broken down on the block and be like, yo, I'm using an FHA and putting a 3.5% down. Obviously, the home has to be a home that you can actually live in. So just wanted to add that in there.
Yeah, for sure. And then there's also a different type of FHA loan called an FHA 203K loan, if you want to get into that.
Yeah, so as you said, right, the first one that you just explained is FHA 203B, just a regular home. You can actually use it as a residential home and the repair cost cannot exceed $5,000. But if you are buying a home that repair costs do need to exceed $5,000, you can use something called a FHA 203K loan. So this is essentially when you're trying to make a home more energy efficient, something's wrong with the flooring, something's wrong with the roofing, et cetera, et cetera. Those are basically the requirements that you need to meet for a 203K. If you do meet those requirements, you're perfectly good. You're able to put the 3.5% down and you get extra money added onto your mortgage as a repair cost. So it's actually pretty cool. But once again, since you are putting, a low down payment, whether it be 10% depending on your credit score or 3.5% depending on your credit score, you do have to pay something similar to a PMI. So I think it's what, MIP?
Yeah.
So do you want to explain what that is?
Yeah, MIP is basically the same thing as PMI. It's just mortgage insurance premium for when it comes to FHA loans. All right, so like we said, the lenders, they're just securing themselves behind their loan. That's all. And just understand that FHA loans, you're going to have to pay that MIP for the life of the loan, the entire time you have the loan. So what people usually do is once they get about 20% or so, they try to refinance out of an FHA loan and turn it into the conventional loan.
Right.
All right. So FHA loans, like we said, one of the most popular loans. But I kind of have beef with FHA loans because a lot of times back in the day, there was predatory lending behind them, right? They weren't allowing a lot of minorities to get access to FHA loans. So what happened was there's a group called NACA, right? NACA loans came about and they actually combated predatory lending. So I want to get into NACA loans next. If you want to explain that.
Yeah, so NACA is actually a dope program. Shout out to my sister because she actually used this program to get her first home, which is super cool. Now, what NACA stands for is Neighborhood Assistance Corporation of America. Now, that's a very long title, which is why people just say NACA. But essentially, it has so many dope benefits. So for one, you don't have to put a down payment. You don't have to worry about closing fees. And you don't actually pay any insurance. So you know how we just spoke about PMI and MIP? You don't have to worry about any of that stuff, which is super nice. However, since it is, such a good loan, there are some qualifications you have to meet. So this is mostly for first-time home buyers because you cannot own another home at the time of closing. So that's something you also have to note. On top of that, you have to go through a pretty long program, I would say, right?
Yeah,
it's pretty long. So there's like a bunch of different steps you have to take to go through this whole process. And if you do go through the process, it typically takes, 4 to 6 months on average?
Just about.
Yeah, so if it takes that long time period. However, if you're diligent with it and you go through the process, you're going to have a great benefit because on top of the other benefits I mentioned, the interest rate is very, very low on NACA. As opposed to 5% right now on a 30-year fixed mortgage, NACA is actually offering 4.3%. So you are saving money on that on top of the other benefits. So I think it's one of the best programs to get involved with. Obviously, it's a long program, as we mentioned, but if you get in, I think you're lit.
Yeah, you're talking about putting zero down for a home. Like I said, they did it for the people. Like NACA has a big focus on giving back to the culture. So shout out to NACA.
And if you're still watching right now, please make sure you like, comment, and subscribe to the channel. On top of that, hit that little notification bell because we drop
2 videos a week.
And you do not want to miss them. All right. So speaking of 0% down and all that other stuff, let's move on to the next one, bro. What you got for me?
Yeah, another 0% down loan package called the USDA Loan. All right, the United States Department of Agriculture, they came out with a loan typically driven towards rural areas, areas that are just kind of, not like city-like.
Right. They're like just outside the city, but, you'll be surprised because just because you think it's like outside the city, it's all agriculture related, you'll be surprised what you can find. So definitely listen to this one.
Yeah, exactly. You want to still look into it because the area that you're looking for might qualify under what they're looking for, right? They might lend to you.
Exactly.
So, there's a few types of USDA loans. Like there's a loan guarantee where you're talking about paying a low interest rate and zero money down. So that's the beauty of it. You have direct loans under them where they kind of target low income borrowers. So, and really low income, they specified really low income borrowers. So if that fits you, definitely look into this. And also you have home improvement. They're willing to give you up to $27,500 for repairs on, the property that you're looking at. So it's wonderful to get into. Like USDA loans, like we said, zero money down, low interest rate. You don't get no better than that.
Yeah, you definitely have a great qualification here. On top of that, if you notice, we're giving you some gems right now where you can actually get repair costs into your mortgage, right? Because people are giving you money to repair that home. So we're not saying you can once again go and get a home that's completely destroyed, but there are programs where you can get money to fix that home and live in it, which is pretty cool.
Exactly. And so, if you feel like you qualify for this, make sure that you fit these qualifications, right? So you want to be a U.S. citizen, okay? Your housing monthly payment shouldn't be over 29% of your monthly income. And then other debts you have, we talking about student loans, auto loans, everything, right? It can't exceed 41% of your monthly income. Your lender and everybody will talk about that with you, so don't worry. And then also you want to have dependable income for 24 months, 2 years, right? They want to see that you're making consistent income for the past 2 years. And then also you don't want to have any collections from the past year, so your credit history better be good.
Yeah, you never want that, honestly.
Don't have nobody coming after you over the past 12 months. You should be good.
You get those calls, you guys got ignore, do not disturb, all that.
Facts.
So that covers what, USDA?
Yeah.
And the next one is actually really similar. It's the Veterans Affairs Loan. So VA loans, Department of Veterans Affairs, gives this to people who are already in, Army right now. They're currently serving, or they're vets, or if you are a spouse of a surviving veteran, you also get this loan itself. This is actually an extremely powerful loan, I think, because essentially you have no down payments and you have no insurance. So it's a great loan to get into. And also, this is another cost. I think if you guys paid attention to the last video, there's something called closing fees, right? We spoke about that. Well, with this loan, with the VA loan, some of your closing fees are actually as little as 1%. Last time we spoke about it, the typical average, I believe, was 3 to 6%. So 1% is a pretty big drop. So definitely make sure you check this out if obviously you qualify for this, which if you do, you're honestly lit right now. I'm not gonna lie to you. This is definitely one of my favorite loans. Now the last one, if you do not have any of the things we just spoke about, right? You feel like you can't qualify for it and you're having a tough time, there is something you can look into, which is hard money lenders. So let's speak on that.
Yeah, hard money lenders are lenders. It could be an individual, it could be a company. They're literally made to give out loans to people who have a hard time getting traditional financing, right? Traditional ways of getting it, like we've been talking about. The catch is, though, they do charge really high interest rates. You know, we're talking about between 7.5% to 15%. But remember, they're gonna allow you to close on a house really quickly,
right?
And they're not making you go through all the paperwork and all the tedious things you have to do to qualify for other loans. So that's why a lot of investors use hard money lenders, because they can get money fast, quick. They'll pay it off as long as the calculations are right. Because, you know, the hard money lenders, remember that you have collateral of the house. So if you don't pay them back in time, they're going to just take your house.
Yeah.
You know, and when they're ready to give you this loan, because they're investors, what they do is they make sure that they look at the property and make sure that it's profitable. So they're going to go over the calculations with you and make sure, like, okay, this is an asset or a house that we're willing to put our money on. So it's a good way for people who need like additional ways of getting into a house, because you can't always go through the bank for everybody, you know? Yeah,
and I know you said it already, but I just want to make sure you guys note this. The interest rate is a lot higher. So make sure you are careful with it and you do have the money situation settled. So I think that basically summarizes all the different ways that we want to talk about today that you can get involved with real estate. But now we just want to go over some quick tips. So one, if you notice any trend in this whole video so far, we spoke a lot about credit score, right? So make sure your credit situation is good. And two, we spoke about having money. So a lot of these depend on your income. A lot of these depend on your debt to income ratio. So make sure you are handling your money situation properly. You have enough savings. You're, focusing on your different income revenue streams, and your debt is not super high. But I know you want to talk about something else as well, right? With different programs like credit unions and stuff of that sort.
Yeah, so credit unions is definitely a thing you could look into if you're having trouble with like traditional banks. So looking at credit unions if you need a different loan, or something called portfolio lenders. Portfolio lenders are lenders that they don't have to send their mortgages to Fannie Mae or Freddie Mac. So they don't follow traditional guidelines that other banks may follow. They actually just secure their own loans, so they kind of make their own rules. So a lot of people look for portfolio lenders because they can give you loans without the same headaches that other banks are requiring you to deal with. You know, so the portfolio lenders, if you're having trouble looking for financing, try to find them. Those are the gems. Look for smaller banks, because banks have to give loans to make money. They want to give you money. Remember that. Yeah. Look for smaller banks that don't get a lot of business, because they will give you loans.
Exactly. So thank you for that. And that basically summarizes the entire video that we want to go over today. And make sure, one final note that I think both want to stress to you guys, is there are always more details around all these different loan packages. Yes. So when you're speaking to your lenders, don't be afraid to ask questions, because at the end of the day, that's exactly how we learned all this. When we're going through a home buying process, we're asking as many questions as possible as well. And we're going to make sure we do our best to provide that information to you guys. So thank you if you're still listening. Make sure you like, comment, and subscribe to the channel, and hit that little notification bell, because we drop
2 videos a week
and you do not want to miss them. Make sure you tune in on Wednesday. But until then, peace.
Peace.